So let's go into our next segment called Wrap the Week and really think about what this means. What we love to do for this part of the weekly journey together is use the Mindful Investor Live chart list. If you've not accessed this before, it's pretty easy to find. Click on the Articles tab on the top of StockCharts. Go to my homepage on StockCharts, which is click on the blog listing, and go to the Mindful Investor, and you will see my page with some of the articles I've written. Live chart list is going to take you right to this place, and you can follow along as I make tweaks to it. It'll update on your side and give you a sense of where things are coming from. So we're going to start with what I call the market trend model. This is something I've followed for a number of years, and it's essentially using weekly data, and it's looking at the 21 and 34 week exponential averages. I actually had a great, deep, philosophical, at times heated debate with our founder, Chip Anderson, earlier this week, and actually it's been an ongoing debate for a while about moving averages, and I tend to use simple moving averages in general. And if you look at my charts, it's the 50 and 200-day moving averages, because I sort of subscribe to the self-fulfilling prophecy thesis. I've met so many institutional investors that look at the 200-day moving average. So I want to know where the 200-day moving average, the simple moving average, is, because I know so many investors that are managing plenty of money are seeing that and are reacting to it. Chip is arguing more from the side of using exponential moving averages, because in general, they're a much better way of actually tracking price movements. And he's not wrong. I don't disagree with that at all. And so it's not a surprise. I sort of told him, I reminded him that my long-term trend following model is built on exponential moving averages because of that fact. I think, if you compare the two, there's no denying that it's a better way of tracking, because it's weighted more towards recent price history, which means it's going to be much more reactive. When the market moves, the exponential averages are going to fluctuate. So there's three pieces here. There are the long-term moving averages, which really the weekly PPO shows you the difference. It's been below zero since mid-March, remains negative. The medium term is the weekly PPO using the traditional 12, 26, and 9, sort of the weekly MACD that most people would follow. And this is so close to giving a buy signal, but has not quite done so. So it'll be interesting to see if we do get a buy signal in the next week or two. We'd have to rally a little further to push the moving averages up a little bit, but getting very close to a potential buy signal there. And then the short term, the tactical period that I look at, was sort of a couple days to a couple weeks, is using the histogram on the PPO, the change in those moving averages, and that turned positive sort of late March, beginning of April, and obviously tracking this short-term tactical uptrend that we've seen. So the model remains short-term bullish, medium-term bearish, long-term bearish. That medium term is getting close to switching. And again, this is not, I would not run a fund based on this as an algorithmic model, but it's more a bias with which I look at the rest of my charts. And I find looking at this often helps me just key on the long-term trend and make sure that I'm focusing appropriately. We already talked about the daily chart of the S&P, so I won't beat the bush too much, only to note that I would want to see a break above S&P 3000, getting above the 200-day, getting out of that resistance range. That's sort of the last line before I think you have to anticipate a return to previous highs or at or near 3,400, which sounds crazy to me still, but you have to follow the trends, and that's what the charts are telling you. That would also have to put an RSI above 60, which I think would be important as well. We've not seen that yet, and so at this point, it's still remaining sort of in that bearish range of oversold to not really getting above 60. That's sort of classic for a bear market phase. This next chart, looking at the cumulative advanced decline lines, this is one of our 3 and 3 charts yesterday, I want to say. And it's basically, another point, as the markets rallied so unexpectedly strong out of these lows, and I know talking with a lot of my peers in the industry, sort of just trying to make sense of how quickly this has reverted back to the upside. I always like to find some ways to try to qualify that and ways to anticipate when we might be getting an end of that rally. And I think for me, looking at the cumulative advanced decline lines on the S&P, the mid caps, the small caps is pretty good. And what we've seen is this continued pattern of higher highs and higher lows, just like the market itself. Small caps just tested that lower trend line. This is not updated for today, and so this is going to improve a little bit as we reviewed over the weekend. But I would want to see a break below that trend line. See these cumulative advanced decline lines start to break below a trend line using the lows, and then break below the most recent swing low. That would be sort of that confirmation that we're starting to rotate lower. We haven't yet, which tells you still that short-term upside is still in play. This is a long-term chart looking at new highs and new lows, new 52-week highs and lows. I'm going to zoom in a little because it's kind of hard to see the most recent data because it was so skewed. That's what I thought. It's still not a ton of stocks. Still a rounding error of stocks making new 52-week highs and lows. If you think about it, the chart of the S&P is literally, 2/3 of the way back up through this overall thing, and that's about right. There are some stocks like Newmont Mining and Regeneron and others making new price highs, Activision, Electronic Arts, all of those. And there are some making new lows, but not many. And there are very few because most of them are in this range. And that's kind of what that indicator is sort of telling you. Going on to our next chart here. So we've gone through new highs, new lows. Our next one is looking at breadth in terms of the 50-day and the 200-day. One of the things I've noticed recently is that we had almost 80% of the S&P above its 50-day, and that's up from 0 about 6 weeks ago. Came back down to the low 50s, but now back up to the mid 60s. So the way to think about half the stocks that broke back down below their 50-day have now popped back up and have recovered right back to where it was before, and in more of a positive trend above the 50-day. A quarter of S&P stocks are above their 200-day, which still means 75% of stocks are below their 200-day, just like the S&P itself is. Again, one of those broad indications telling you things are quote unquote getting better is this indicator getting back above 50%, which means over half of the stocks in the S&P have recovered, have reclaimed their 200-day moving average. You saw that in mid-2009, sort of confirming that the 09 low was the low. We're not there yet. Sentiment's an interesting one. If you look, excuse me, over 50% voting bearish in the latest AAII sentiment rating. Again, I'm not a huge follower of sentiment in the form of surveys. I think they're anecdotal. It's the same way I would follow magazine covers. I wouldn't trade based off of the Economist putting a certain bullish or bearish theme on the cover of their magazine. But I think it's interesting anecdotally to understand what themes people are interested in, what sells magazines essentially, right? And the same thing with surveys. I'd much rather follow price and see where people are actually voting with their capital. But I think it's worth noting that over the last 6 weeks, you've had less and less bulls overall every week that they've been surveyed. So less and less bullishness as we've gone higher. This is a really interesting chart here, and we'll just have a couple more before we need to take a break. This one is looking at the ratio of the XLY versus the XLP, so consumer discretionary versus staples making a new swing high again this week. And again, that's driven by Amazon primarily, and you can see that from the bottom clip, which is looking at the equal weighted consumer discretionary versus staples. So if you see the top panel moving higher, the lower panel has not quite made a new high, and that's because Amazon really driving the ratio higher on the upside. So overall, still not as much of a vote for strength there. Now, the last one I want to finish off with is looking at the relative performance of small caps versus large caps. One of the themes that's been so beaten in my head, I feel like, analyzing these markets is the underperformance of small caps. And this is over the last year. You can see that, the sell-off in stocks wasn't the beginning of that underperformance. It's been happening for quite a while. But if you look, it's just starting to really improve on a relative basis. You had that spike higher, pullback, and now rotating back higher. And again, on a day like today, when the S&P was up 1.5%, small caps, mid caps up 3-4%. And we're starting to see that more than we're not. And that's why that ratio is starting to go higher. So an emergence of outperformance in small caps is something I've been talking about for a while as one of the challenges, one of the things we have not been seeing. If this continues to go higher, I think you have to start to acknowledge the fact that those higher beta groups are actually starting to improve just a little bit. That's our weekly wrap for today. Again, so many themes to think about, and a really fascinating part in market history, I feel like, as we've recovered so well. So hopefully some of these charts help to fill in some of the blanks in your own thinking.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.